Money FM 89.3. Best of breakfast. The Bigger Picture, only on Money FM 89.3.
Welcome to The Bigger Picture. I'm Dan Koh. Now, in a widely anticipated move, the European Central Bank cut interest rates on Thursday. It marks the 8th time the ECB has lowered borrowing costs by 2 percentage points since last June. That's as it seeks to prop up a Eurozone economy that was struggling even before erratic US economic and trade policies dealt it further blows. With inflation now just below 2%, ECB President Christine Lagarde said that the central bank for the 20 countries that share the euro was in a good position with the current rate path, a signal of possible end to its policy easing. What could this mean for the euro economy and markets, and who are the winners and losers of this latest decision? Well, let's find out with Abhilash Narayan, the investment strategist at HSBC Global Private Banking and Premier Wealth. Good morning, Abhilash. How are you doing today?
Good morning, Dan.
All right, we've got tons to break down, so let's start off with the European Central Bank, which I've mentioned earlier that cut interest rates as expected on Thursday and kept all options on the table for its next meeting. So how are you reading the ECB's recent rate cut decision? What were the biggest takeaways from that meeting, and how did markets react to it?
Yes, Dan. I mean, if you look at the rate cut, that was well expected by the markets. What was of more interest was, the forward guidance that we would get from the ECB. And I think there are 2 or 3 key takeaways from that. So the first one is that, ECB did indicate that they are sort of well positioned and they will be data dependent and take a meeting by meeting approach. And I think President Lagarde also said that the rate cutting cycle has just nearly concluded. So indicating that we may get a pause from the ECB for the next few meetings, which is expected because, by our estimates, the neutral or the appropriate rate for Eurozone is between 1.75 to 2.25%. And right now we are at the middle of that, 2%. So I think that's one takeaway. The second one is actually the ECB did revise its inflation projections for both 2025 and 2026 lower by 0.3%, due to the strength in euro we've seen and the decline in oil prices. But it didn't commit to more rate cuts. So I think it's keeping some of the powder dry given the uncertainties we have regarding the trade talk with the US.
Yeah.
When we put all of this together, we think from an asset market perspective, it still makes sense to have a neutral view on Eurozone equities and the euro. But we see that there are some opportunities in high-quality investment-grade, euro-denominated corporate bonds.
All right, then let's dive a little bit deeper into where you see opportunities. Who might be the potential winners and losers from this interest rate cut? And how do you expect to see investors digesting news of this cut over the next few months?
Well, to be fair, this rate cut was largely expected. And if you look at the market moves, the moves in the euro especially, it didn't do much, indicating that what we got was broadly in line with expectations. In terms of sort of winners and losers, we think that the fact that ECB has indicated that rate cuts are probably largely behind us could actually be, somewhat of a positive for the banking sector because it will help them sort of defend their net interest margins a little bit better.
Right.
The other thing is, the fact that we may not get a lot more rate cuts from here could also be positive for euro investment grade corporates because up till now, the credit spreads there are somewhat cheap. So, with rate cuts largely behind us, we could start seeing markets focus on corporate fundamentals a bit more, and we could see some spread compression leading to capital gains for bond investors there.
Right. Certainly some good news for the bond markets. Thanks for sharing with us, Abhilash. Now, I'd like to turn our attention over to the US, where we've seen how their services sector contracted for the first time in nearly a year in May, while businesses paid higher prices for inputs. That's a reminder that the economy remained in danger, especially with the effects of Trump's tariffs starting to show. So does this suggest that, markets are only going towards a downturn from here on out?
If you look at the data, there is a bit of divergence in US. So as you rightly pointed out, services PMI from ISM moved marginally into contraction territory. But at the same time, if you look at another data provider, S&P, their services PMI actually rose to 53.7. So, there is a bit of divergence in the data. So we need to see, whether the divergence resolves to give us a stronger signal, or is it just, blip for 1 month.
Right.
But you're right. I mean, given the ongoing uncertainty around U.S. tariffs, there is a fair degree of navigation that companies and investors need to do. And given the sheer volume of U.S. policy announcements and the U-turns, it's difficult to have or quantify the impact on growth and earnings. So in the near term, we think that investor sentiment will oscillate between risk on and risk off modes, but we think that eventually tariffs will come down through negotiations. So we'll see a slower growth, but not a recession. So we still have a mildly risk on view. We think that equities will end higher from where we are today by end of 2025.
Right. That's comforting to know at least. Thanks a lot for that, Abhilash. Now, I'd like to talk a little bit more about the impact of Trump's recent tariff hike in terms of the steel markets, because we've seen how Trump has recently hiked the import taxes on the metals, which are used in everything from cars to canned food for the second time in March. So that brings, the tariffs on steel and aluminium imports from 25% to 50%. How do you see this playing out in the markets, and what are possible implications of this hike?
Just another example of the uncertainty the markets have to deal with. But I think from a perspective of Asian investors or Asian economies, I think the impact is likely to be limited, because if we look at the breakdown of where U.S. imports its steel and aluminium from, it imports 50% of its steel from Canada, Mexico, and Brazil. In fact, China is just accounting for 2% of U.S. steel imports. So the impact on Asia from steel import perspective is limited, and the same goes for aluminium. U.S. imports about 50% of their aluminium from Canada and Mexico. But I think what the other sort of uncertainty is, we do not know the duration of these tariffs, whether they are long-term in nature or could they be reduced in a matter of few weeks or a month. So that adds another layer of uncertainty. Right. I think what matters more for investors going forward is, the 9th of July, which is the date when the 90-day period of, pause on reciprocal tariffs sort of ends. So I think as we go through the rest of June, markets will start to focus more on that rather than, tariffs on individual metals.
All right. Thanks a lot for that, Abhilash. Now, I'd like to turn our attention closer to here in Asia, where we're seeing the Reserve Bank of India's Monetary Policy Committee beginning its 3-day meeting in Mumbai to assess the current interest rate outlook. And market analysts are anticipating a rate cut in the upcoming RBI MPC announcement today. And experts believe that a 25 basis points cut seem most likely as the central bank looks to further support credit growth and economic momentum. What would a rate cut mean for the Indian market? Which sectors stand to gain from this cut?
Yeah, absolutely. I mean, we are also expecting a 25 basis point rate cut in the current meeting, and we think that RBI will cut cumulatively by 75 basis points and bring the benchmark repo rate down to 5.25%. Now, from a market perspective, the RBI rate cuts would be supportive for growth, and from our perspective, that's positive for Indian equities as well as Indian bonds. So if we focus on equities, we think financials continue to do well, while their net interest margins could come under some pressure. The fact that interest rates would be lower could actually spur greater loan demand, so that would be good for them. Industrials and, to a certain degree, consumer discretionary sector could also, benefit from the rate cuts. As far as bonds are concerned, we think that 10-year benchmark Indian government bond yields could, edge lower towards 6%, aided by the rate cuts, and the fact that, technicals remain fairly strong. So overall, a fairly positive outcome for Indian equities and bonds if the rate cuts do come through and the forward guidance is supportive.
Yeah, it does seem like economic data is also supporting at least calls for a rate cut, with retail inflation staying below the 4% threshold for 3 consecutive months, and the decline in food and beverage inflation contributing to this lower inflation rate as well. Now, Abhilash, before I let you go, I'd like to have some of your final thoughts. Amid the uncertain tariff environment and global tensions heating up, here's the million-dollar question that we're all thinking about. How should we be putting our cash in the markets today? Where are you seeing risks and opportunities?
That's obviously the most important question. So, I think from our perspective, from a macroeconomic perspective, we think we'll see a slower but positive growth, but there will be a lot more volatility both in economic data and earnings data. But at the same time, central banks will keep cutting rates. So what this means is we are still in a risk-on mode. We are mildly overweight global equities, but we think that it makes sense to diversify equity exposure. So we are overweight on U.S., China, Singapore, and India. But at the same time, as I mentioned, we expect markets to be more volatile than what we've been used to. So for investors, it makes sense to build buffers in their portfolios to manage short-term volatility. And how they can do it is by, adding allocation to multi-asset strategies, alternatives, and high-quality bonds.
All right, fantastic. It's been such a pleasure having you share with us the impact of the possible rate cuts across Europe and India. Thanks a lot for joining us this morning, Abhilash.
Thank you. My pleasure.
We've been in conversation with Abhilash Narayan, the investment strategist at HSBC Global Private Banking and Premier Wealth. Keep it right here with us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.